let's also welcome on board Sanjay Parekh, who is joining us on the show right now. Hi, Sanjay. Good to be speaking with you. Sanjay, a lot of sectors that are in focus on the back of the news flow. And firstly, let me start with the OMC pack. As we have the numbers coming in from BPCL just yesterday, and now just a while back we have the numbers for IOC, and the numbers look damn great. Help us understand that how do you see the numbers as well as the sector view for OMC?
Yeah, so in ONC, we don't have an exposure right now while we track it very closely. So, one issue is the uncertainty in terms of the profitability. So, as you know that while refining margins are linked to global prices, marketing margins on a gross basis are based on the market prices, but the LPG under recoveries is still uncertain in terms of, how much would be borne by the companies, how much would be borne by the government. It's still very fluid. So predictability of earnings now gets difficult. And then you saw excise duty increase by the government. Uh, as of now, they are making very good spreads because the crude has eased off, and you do tend to make very high marketing margins if the price has not reduced. And we've not seen price reduction on a retail level. As I said, a bit of excise duty increase was there, which goes to the government, but yet the spreads are still very high. But what we need to see is net of LPG under recovery, whether that is a sustainable spread. So our problem is the uncertainty and not predictability in terms of the marketing margins. And hence, while the valuations are great, results have been good, but that is our discomfort.
Right. Sanjay, I have to know, just wondering what's the market call right now? We've done well for ourselves in the last 1 month since the tariff announcement on April 2nd. The FII money as well seems to be coming back. But does it seem like it's tactical and short term in nature, or do you think the FII buying is here to stay?
I think what is coming out is globally we perceive to be better off, much better off in this whole chaotic scenario in the world of the tariff issues. And our relationship is uh, optically looking quite stronger with US, and hence maybe the expectation is that we would have a mild impact in terms of the tariffs for India. Having said that, I think it's still a very chaotic world. There can be second order effect as well. While China, US, the whole issue will take time to resolve. It could have a lot of ramifications in terms of import vulnerability, our export threat. In a sense, if we are exporting somewhere in the world, would China not try to dump there? Because the capacities are huge and they are overcapacity in a lot of sectors. So I think it's a very fluid scenario. We need to be a little cautious, and on domestic side, earnings also are not going to be great. We have a weak earning season. We've seen some of it which are good, but now we're going to see what is going to come out also. You'll see some disappointments. So the expectation is earnings will be more like flattish or minor growth. The key point now is recovery. Will we have recovery in this environment purely on domestic growth and within this global chaos? I think that is one thing that we need to watch. And there, I think, we do carry some risk and we need to be a little careful. Structurally, we are very, very positive because all the balance sheets are in good shape, but near-term valuations are, I would say, more like fair value. So I think there could be a time correction and price correction. Both is possible of 3 to 4% price correction, maybe 3 to 5% price correction, some time correction, and some clarity on this global scenario because it's important for us as well.
What's been your own strategy right now? What is it that you've done in the past month? Bought anything afresh? Completely avoided something?
Yeah, so our portfolio is more domestic heavy. We overall financials we are overweight. We are Banks, larger banks we own and we like them and it's worked well for us. Discretionary space, we have autos, both Maruti and Mahindra. And then on capital goods, we are positive, we have overweight there as well. And then we have utilities, mild overweight on pharma. IT are underweight because we think the growth is going to be slow. So there we are underweight. And oil and gas, we have some representation to Reliance, but overall we are underweight. So, and then metals, we are overweight with Vedanta. So that's where telecom, of course, we are overweight. We are big overweight in telecom, both through Bharti and Indus Towers. So overall, our portfolio is tilted towards domestic and less global, and it's worked well for us by now.
All right, but Sanjay, within financials, we have two of the news makers. First one is Bajaj Finance, and the other one is IndusInd Bank. With respect to Bajaj Finance, though the guidance is not looking that exciting, and there's a bit of a profit booking on the stock, but we can't complain much given the fact that the stock is already up 25% on the YTD basis. And on the IndusInd Bank, who will be heading the bank next? That's the key question. Give us some sense that how do you see both of these financial measures, and what's the outlook here?
Yeah, I think Bajaj Finance structurally is very, very good. Long term, if you take ROEs, growth, they've done phenomenally. And as you rightly said, it's run up quite well in the last 3 months and it catched up on the underperformance which it had in the past. And hence, some profit booking. And to be fair, their credit cost is higher than expected due to the changes in the ECL model that they said. But certainly the street would not like where, as early as third quarter, they had said that they want to be in the range of 2%, but it ended at more like 2.3% plus. So I think that was a little bit of disappointment, but otherwise it's an absolutely top class management. And at a price it looked reasonable. It's run up, so valuations are rich. And it is at a price once an entry price which could be a little lower, and it will look very attractive to invest again from a longer term point of view. The IndusInd Bank, I think it's a fifth largest bank going through a temporary pain, and you will see change. All the right things are happening in terms of you'll see leadership changes. I suppose RBI is also very proactive and are handholding the senior management. You've seen some notice being put by the management and confirming by RBI. So I think they'll work through it, navigate it. We don't think there's a structural problem. There was certainly a pain in terms of the way they accounted the derivative book, or if there is any minor slippage in the microfinance book. But the size of the profit, if you look ahead, is still going to be very, very good. It's a lakh crore deposit franchise. They've done a lot of good things over the last 20 years. And once the leadership situation gets better, which in the right leadership team comes through, we are quite hopeful that things will fall in place.
Right. Okay, that's the take coming in on how financials should be treated right now. But Sanjay, what's the take that you're, analyzing PSBs with? You've got SBI's numbers over the weekend. Some of the smaller banks have actually given a positive surprise. The MFI segment clearly continues to see pressure. Where do you think PSBs are headed next?
So PSU banks, you suppose? Yeah, okay. So, what I heard is people asking me on PSU banks, right?
Yes,
Or
that's
PSU
right.
banks, that's
I'm
right?
asking you about private sector banks, or rather public sector banks.
Okay, yeah, perfect. No, so we own SBI and we are quite positive. Only thing in the near term, and there could, because the repo rate cuts have happened, so the asset side repricing happens faster. So as we have seen, and it could happen that there could be some pressure on NIMS and NII. That could be even not only for the coming quarter, but more so for the first quarter ahead. So this would be a year of low growth, is what we think. But however said, the franchise is very, very strong. They have an ROEs in excess of 16%, ROAs around 1%. They manage the credit cost very, very well. And we believe that, this phase of repo rate cuts led pressure on NII is a temporary phase. Longer term, uh, uh, we are quite positive, and it's stable at less than one time on FY27 price to book X of subsidiaries. So that's where we're positive. Other PSU banks, we'll prefer the largest name, and you would have their representation. And we don't own the rest at the lower levels.
All right, Sanjay, with this, we let you go on that note. Thank you so much for taking the time out and speaking with us and giving us a sense that what exactly are you looking at in the markets at this point in time.